Welcome to the Grizzle Critical Minerals Roundtable. At a high level, critical minerals have always been at the core of how Grizzle looks at the market, especially with respect to the supply chain towards disruption. For a long time, we believed this dynamic was heavily underappreciated by the market, but over the last 12 months, we are seeing a real pivot and the market beginning to wake up. Copper is obviously at the epicenter of this conversation, but we're seeing it across the entire critical minerals landscape. It has become an incredibly dynamic space, driven by a combination of massive disruption in AI infrastructure paired with the pressing national security concerns. We are seeing a plethora of drivers making this a clear area of long-term growth and investment. To dig into all of this, we brought together a fantastic group of companies and speakers today. Scott, take it away.
Sure. So as commodity investors ourselves, we know there's a lot of data being thrown at you every day, and it makes it hard to not just be a little bogged down in the weeds. And so the goal of Critical Minerals is to step back a little bit, hear from a diverse group of speakers, so you can see the overall big picture drivers of demand and supply that are moving these commodities. So first, you're going to hear from Corey Diaz. He's CEO of Anfield Energy. Anfield is imminently restarting one of only 3 permitted and constructed uranium mills in America, so a good resource for insights on uranium and nuclear. Next is Kevin Flynn. He's CEO of EcoraRoyalties. Ecora owns a truly diversified critical minerals royalty basket that's in high demand right now with everything going on. Next, you'll hear from Christian Easterday on the copper front. He's CEO of Hot Chili. They're advancing one of the largest copper projects in the world that's not owned by a major miner, so he's a great resource. Next up, we have Tracy Shuchart. She's the founder and chief market strategist of commodity consulting firm Hilltower Resource Advisors. If you're on social media and in the commodity space, you've probably run across Tracy. She's well known on X.com in particular for her timely analysis of copper, oil, and precious metals markets. In this episode, she's going to walk us through her fundamental outlook for copper. And finally, we have Michael Williams. He's chairman of Aftermath Silver, and he's going to help us better understand silver's role as a critical mineral beyond its historical role as just a store of value. So without further ado, I'll kick it back to Tom.
Yeah, so it's a great group of companies, and more importantly, a great conversation with incredible insights across the periodic table. If this is a one stop, you get your Critical Minerals 101. Enjoy the conference.
Yeah, like I think energy is a massive topic worldwide today. There's a lot of geopolitical risks, as you can see, associated with energy sources. Throughout the world. The wars kind of exacerbated the concern of control of certain assets, which would allow for energy independence, for example. I think nuclear is in a great position, given that it's low cost baseload power that can sustain significant populations worldwide. And I think the market realizes that, and certainly countries and sovereign nations realize that because they're building reactors in a number of places. If you look at the pipeline, we've got about 440 roughly reactors worldwide. We've got a pipeline of potential build out of another 70 or 80 kind of planned and proposed, and then another probably 200 or so which are under consideration. So overall you could see close to a doubling of reactors worldwide if everyone is accepted and move forward on. So I think that is kind of a critical piece. And when you talk about the mining side, this is just ignoring the mining side, which has no real growth prospects, certainly not at the current prices. So it's going to take a big and heavy lift from the mining side in order to meet current demand, because there's a supply deficit, even if you were to run all the mines today. But certainly in order to meet, increased demand, you're going to need a lot more mines to come online. And so I think being, and I think you see this in if you look at the US market itself, once again, a market that has, the largest install base of reactors in the world, but yet produces about 5% of what it requires and gets a lot of material from friendly nations like Australia, Canada, but certainly, is dependent on other places of greater geopolitical risk like, Kazakhstan or Russia, Uzbekistan. And so, the ability to, become energy independent, which is the aim for the US, it's challenging, especially, given that they need to produce, close to 50 million pounds internally in order to meet existing demand, notwithstanding the fact that there's another 25 reactors in the pipeline in the US, on top of the 94 that are installed. So if you look at the processing capabilities, the processing capacity amongst all of the existing players in the market in the US, and if you ran that at 100% of production capacity utilization, you're probably looking at meeting 50% of demand. So processing is a massive issue, notwithstanding the fact that there aren't as many mines available, certainly not the price where we are today. So there are so many challenges in terms of where the price should be, in terms of processing capacity. And it's not just in the US, this is something you'll see worldwide. So I think that, nuclear is in a great position, from the position of how to provide baseload power to, thousands and millions of people. The flip side is there are not enough material in place, there's not enough processing available, and certainly the price today is not going to incentivize new mines coming online. So, what's the solution? Higher prices, government intervention from permitting, and government intervention from funding, getting those processing facilities out and providing funds in order to build out processing. So, a number of opportunities available, and certainly we're well positioned, especially in the US, to take advantage of it. But we're still, it's going to take some time for, I think, the government to catch up to funding the uranium side. They've started work on the nuclear side. They're working their way down towards fabrication, enrichment, conversion, but nothing's really been put aside for mining yet. And so we're hopeful that's going to be the case sometime this year. I think the biggest catalyst will be how aggressive the utilities come into the market. They haven't been aggressive. They've been very slow and steady in terms of re-entering the market. But I think, once, almost panic sets in and more aggressive RFPs are put into the marketplace, I think that's when everyone will realize, how large the supply demand imbalance really is. There's always news around. I mean, we had the Cameco news with the bridge potentially delaying or slowing down production at Cigar Lake. There are always small catalysts in the market which will have an effect on, the perception of supply demand or lack of supply. But, we've talked about build out of reactors in China, build out of reactors in other places in the world, and not a lot on the supply side, being increased or brought online. So it just takes kind of little moves in the market for, the small, steady, push for snowball effect to really, bring all these issues to the fore. And I think that's what we're starting to see a little bit now, but, it'll take a little bit of time before it turns into a kind of a full, full blown panic. I think we need high prices. You don't see a lot of mines coming online, today or have recently come online, given an $85, $86 term price. I think, ultimately, I think their contracts probably being signed higher than where the spot price is showing today. I think you need to have triple digits in order to bring those marginal projects on. So I think there's still a lot of upside in terms of the price before you get, new projects coming online. Well, I think the original PEA contemplated contracting out a lot of the work. And so we'd have third-party contractors, which obviously have kind of margin requirements in order to build things out. But we're actually, we've hired staff in-house in order to address a lot of the rebuild or new build. And so being able to control those costs has allowed us to kind of mitigate some of the inflationary pressures that were, found between 2023 and 2026. Yeah, it helped for us. It helped, to understand the assets a lot better too. Just, as we start digging into them, we understood, what exactly do we need versus kind of what we were hoping for or planning for. And so being able to kind of be a bit more granular as to what our actual needs would be, helped alongside hiring people to do the specific jobs that we need. I think we're going to finance through a combination of equity and debt. The ratios will be determined in the near future. I think we're looking at the possibility of getting, government debt, U.S. government debt, long-term low interest rate loans out of Department of Energy. Apparently they've got a pool of funds which are to be used for processing facilities. For example, the Shooting Canyon Mill. DoD does provide grants for mining assets. As to when the money's available, that's still a question mark, but certainly there's a potential of funding through U.S. government. We're also looking at debt lenders, credit facilities right now. We're engaged with a few parties to seek that kind of funding. Probably looking at maybe a 30% equity, 70% debt combination. But we're open to kind of mixing and matching all of these types of financing options. Well, I guess if we consider the radioactive materials license a permit of sorts for the mill, we expect to see that by the end of the year. Our permits for the JD8 mine. The plan of operations has been submitted, after which, we hope to get that permit by the end of the year for mining. We're also looking at SM18, submitting a plan of operations this year, after which we'd hope to get the mining permit for that asset. Slick Rock, we are also in the process putting together the plan of operations, after which we'd receive a permit. So the idea is to get these permits for mining by the end of 2026, early 2027, to complement getting the radioactive materials license by the end of this year. We've built the mill and the mill capacity to take on the material that we have within our portfolio. We could certainly look to adjust the portfolio to incorporate mines from third parties, and it's something we've certainly considered, because we've had discussions with multiple parties about the idea of toll milling. So there's enough flexibility within our model to either fill it all ourselves or bring on third-party material. I think the first one, there's a couple, I guess. So we've got the license itself, getting the approval by the end of the year. We're also looking to pull some of the items that are in the mill today, equipment, et cetera, that won't be used going forward. So we'll be doing a little bit of kind of decommissioning, if you will, at the mill site. So pulling out the leach tanks, changing the electrical, changing the power generators at the site, in anticipation of getting that license in place, which will hopefully help us accelerate the refurbishment at the mill. Other catalysts include getting the plans of operations, the mining permits, submitted and accepted by, the state of Colorado, and from a federal level, getting sign off from BLM, DOE, DOI, in order to allow us to start construction at those sites. For example, at JD8, the restart of that mine will be fairly low, about $1 million, given that it's an existing mine. It has, open adits, it has equipment at site. It's, these are fairly kind of low cost turnkey assets. So, we're in a great position to get those mills ready, those mines ready for production in the relative near term, just seeking, the permits in order for us to do that.
Yeah, I mean, my thoughts on that, I think there's little doubt that the longer term thematic around electrification is going to be positive for copper. There's little doubt as well that, it's getting longer and longer to permit and bring new copper projects online. So, the supply demand projection for copper, we think is very favorable, certainly from a pricing perspective. And you're right, macro events, softening GDP numbers, a lot of macro volatility and uncertainty recently, should have had some impact potentially, but we've seen supply disruptions as well from a major producer too. So, I think you've seen a period of still gradual demand growth for copper coming at a point where there's been a supply blip as well. And that's certainly bolstered prices in the short term. But, if you look at copper more generally, the economic kind of grade cutoff for copper has come down a lot.
The incentive price has increased primarily as a function of increased input costs. The royalty model is perfect for that because we operate on a nominal basis. So, if the incentive price required to bring new supply online keeps pushing up with inflation, then that creates upward momentum for the price environment too. And I think the royalty model is a very good place to get your exposure in that respect because you're not penalized for any capex or inflation cost drags associated with that, and you participate at the income line. So I think fundamentally, if Ecora is quite bullish on copper, we'll certainly expect to see reasonably robust copper prices this year and next. And then the thematic, as I said, we expect to continue. Yeah, we are. We're not fully unique in that we're critical minerals, but we are very diversified amongst the non-precious royalty and streaming companies. Certainly, I think critical minerals has been a deliberate strategy of ours over the last number of years, even decade, to kind of recycle legacy coke and coal cash flows to build a future-facing business. I think we're very proud of what we have built, created, and the layered growth profile that we now have within the portfolio. But you're absolutely right. Critical minerals is more than copper. We do want to retain base metals at the core of our portfolio because those metals are very well understood. I think once you go into more niche products, which we have done, vanadium, rare earths, etc., I think that does create a bit of market education. But there's little doubt that these minerals are very important to the overall concept of electrification. And, given what's happened over the last couple of years, defense as well. So, we want a rounded portfolio. I think the royalty and streaming companies that tend to do the best are those that have the lowest volatility at earnings level, which means the more diversification you can have, the better. And I think we've still got a journey to go on that path. But we've infilled with some rare earth exposure very recently. We've obtained some nickel exposure. We've obtained vanadium exposure 10 years ago. So these are things we look at on a daily basis. But I think copper is where we like to see the kind of core component of our portfolio. Yeah, sure. Look, I think a couple of years ago, the whole story was around EVs. Ecora never branded itself as an electric vehicles royalty company. Our focus in terms of kind of more broader kind of macro themes has been around electrification. And, that can encompass how energy is produced, how it's stored, and then ultimately how it is used. And I think, whatever way you look at critical minerals are required in each of those components. So we're not narrow in terms of our focus and where we ultimately kind of call one or another, if you like. I think the broader theme of electrification is where our portfolio has been built around. And as I said to you a minute ago as well, I think, my view is that I think Western governments are going to really think hard about cutting back any defense spending, certainly in the near term. And I think an area like that that's been underinvested in for so long requires so many critical minerals as well. And I think, you are seeing a move by Western economies to obtain a secure supply of some of these critical minerals. And I think that's going to continue. So, it's not the perfect answer for you in terms of picking one. But for us, it's very much around the broader theme of electrification in its different forms, and then which commodities are key to that. But then it's about what point in the cycle you're at, entry point, long-term view on pricing, etc. But we're very pleased with the portfolio we've put together. We think it gives investors good exposure at income-producing level to critical minerals. And as I said, with a nominal business model, you don't need to worry about the associated cost drag that brings margin compression. Yeah, sure. So we are London listed. So, we have invested a lot of time kind of investing in our presence and our kind of brand awareness in the North American markets. But Ecora fundamentally tries to differentiate itself in so much that we tend not to focus on precious metals. Precious metals is a very well-served market in the Canadian market. We focus outside of that and have built a portfolio with copper at its core, but mainly around critical minerals. So if you look at our portfolio today, um, you know, 50% of our stated NAV is in copper. Over 80% is in base metals, and that's a complexion we like. We haven't had to travel off the beaten track too much in terms of jurisdiction to obtain that exposure. 85% of our assets are located in OECD jurisdictions. Importantly for us, in times of inflation, 80% of our assets are in the first or second quartile of the cost curve, which is hugely important when you're trying to invest through cycle, because your risk in the royalty sector is the binary risk of production. And for us, and maybe what differentiates us a little bit more as well from some of the smaller to junior side of the sector, 50% of our NAV is in production. So you get that torque to current spot prices through Ecora, rather than spot prices or long-term prices influencing NAV, for instance. So, we've got some real cornerstone assets in our portfolio, some fantastic growth catalysts in there as well. It's probably the most exciting 12 months from this point on that I've been involved with the business, where we expect very tangible catalysts to come through for us. But as I said earlier, diversification is key. Diversifying our income further is a focus of ours, because, I think with the royalty model, to have low volatility is also important. So very keen to use this amazing platform that we have with the assets that we've put into the business to continue growing and diversifying. Yeah, it's a good question. I've been with Ecora now as CFO for 14 years. So I've seen the industry evolve, certainly. I think when I started, even if I look at it from a micro perspective, Ecora was Anglo-Pacific. It was a coal business, frankly, with a vision to use cash flows to diversify. When I started, my impression of royalties was almost that it was a product of last resort by a lot of boards, just perceived as very kind of dilutive, margin eroding, and a perception of it being very, very expensive. And of course, when I joined, still at a time when the conventional capital markets would have been more accessible, certainly on the junior end. So what we've seen as the royalty and streaming product become very commonplace in the capital structures of a lot of mining companies. I mean, we've recently seen BHP do a very large stream themselves. That's a primary transaction that they've done. So it has become much more better understood, much more mainstream. But the royalty product tends to work best as part of a joined up solution across the capital structure. And that in its own right should provide plenty of opportunity and deal flow for us as we continue our growth journey. In terms of the products, I think royalties and streams have always existed. Streams have probably become much more prevalent, certainly in the precious space. I think for most people writing new contracts themselves, so not acquiring existing ones, I think streams have become more common, but that very much depends on what suits both parties. The economics are very, very similar, and that's an important point. But I think we've been very innovative as well in terms of some of the structures that we've put in place to ensure that the financing we're providing works for our counterparties. This is a relationship business, where relationships really matter. Once invested at the royalty level, you're invested for life of mine. We can't trade in and out like an equity investor can. So, that's kind of how I've seen the industry evolved over the last 14 years that I've been involved. I think our capital allocation pillars are very much pointed to growth. I think we're not at a point in the cycle generally where we should be distributing back and not investing. I think we still see very good deal flow and opportunities. And what's good for Ecora is that we can deploy across a larger commodity basket than just gold or silver, for instance. So, we've had instances in the past where lithium has run too hot. We've invested in cobalt. We've had copper running too hot. We've gone into vanadium. But we've also identified some pretty sensible entry points to copper. So, while the deal flow and the macro environment is still very favorable, I think we're probably still in an investment phase where we're kind of what's becoming kind of more pivotal for us is our ability now to finance bigger things. In the last couple of years, we've very much had to rely on our balance sheet to finance our growth because our equity rating had drifted so considerably. Um, and as that rating has improved somewhat, it does increase your ability to finance larger deals, even on a blended basis. But even as I look at it today, our net debt is probably close to $80 million now. We have a 1/8 facility with the accordion to bring that up to 225. We've still got firepower available to us, and we don't feel like we need to stretch or lean into heavily on long-term commodity price assumptions to continue growing. So yeah, for us, as 50% of our NAV is producing, we obviously generate cash flow. We're a royalty business that drops to free cash flow, which allows us to delever. But the deleveraging itself just enables us to grow even more. So I would say Ecora is still very much in growth phase. Yeah, I suppose in my view, it's just continued delivery by our portfolio. For the last 12 to 24 months, our message has been very consistent. Our portfolio, particularly Voisey's Bay, is ramping up. We have a lot of conviction in that. And I think what we saw last year in the second half in particular was that kind of reaching closer towards its nameplate capacity. I think as this year goes on, we're going to see that continue. We're going to see continued ramp up at Mimbula, which is our recent acquisition. So I think the more we can show the market the free cash flow potential of our portfolio, I think that really helps in a meaningful way because that is exposure at cash flow level, which enables a greater pool of capital for investment as well. I think the other thing is it'll become much more visible, the quality of our earnings as well, particularly as Kestrel kind of rolls off from our private area in a material way in the next kind of 12 months. We now have a core portfolio of assets whose production profiles you can discuss in decades rather than a very short-term nature, which we previously had. In addition to that, at a much more kind of tax-efficient structure. So the free cash flow conversion increases. And I think as all this gets demonstrated, I think the team have got an incredible track record in terms of their ability to generate deal flow and execute and be known broadly in the industry with a very good reputation helps too. So, I think Mark and I have got a lot of conviction in the portfolio. We're very proud of what we've built, and we've put our money where our mouths are. Very recently, we've bought stock on the market ourselves as well. So, we've been constant buyers over the last couple of years. So, we certainly are putting our money where our mouths are in respect of that too.
Yeah, look, that underlying thematic on the supply side has not changed. It's probably getting worse. The world is very focused on disruption, very small disruptions. Even the miss by Codelco the other day has copper near record high, and as you said, in a very geopolitically unstable environment at the moment, from January, where we saw copper tap those record prices along with silver and gold and a number of commodities. It is really copper that has rebounded very rapidly, and I see a situation where we have been seeing this coming for a very long time, and great to see it finally arrive. I wouldn't be surprised to see $7 copper very, very shortly. Sure, Scott. Well, look, one thing to understand about copper, and this comes back to the supply side, and why we're seeing record copper price now. These deposits take a very, very long time to develop, around 21 years on average to go from discovery through to production. There are very few large scale or meaningful deposits that are development ready available in the world, particularly outside of the hands of the majors. And they're very, very capital intensive to develop. So Hot Chili is holding a project which we've been developing on the Chilean coastline now for around 17 years. It's a 3.5 million tons of contained copper and 3 million ounces of gold, and very, very lucky to have that in a growth phase at the moment, pushing towards 5 million tons plus of contained copper. But this is really one of the key reasons why we see inertia in supply. This supply response to this cycle has been very, very muted. Mostly new supply from the copper sector with each of these cycles has been met by declining cutoff grade, and so therefore the head grade of average copper production in the world, which is around 0.5%, has tumbled over the last 25, 30 years from about 1.6%. So we see the grade of production decreasing. We see the cutoff grades near terminal at the moment, which means that it's very, very difficult to reduce cutoff grade and get much more copper out of the tons that you're processing. So we're approaching a situation of copper scarcity, and that is directly impacting price. Where it looks like this copper cycle is going to certainly elevate to a price that we haven't seen before, and I believe that will be very, very sticky for the long term, owing to really what is a carve out of an entirely new demography of demand in the world related to electrification, related to electric vehicles, renewable energy, AI, and all of the things that people are hearing about now almost on a daily basis. Yeah, sure. Look, the majors are very rational in their approach to growth. In relation to copper, a lot of the very big mines in the world, if you look at the top 10 mines, I think we have an average of around about 38 years of mining that has gone on at those top 10 deposits around the world. So, most of these deposits are very old. They're starting to be depleted. But the copper sector and bringing on new copper supply is a very, very capital intensive business. At this stage, the majors have been focusing on brownfield expansion. Look, it is very much less risky business to expand an existing mine than it is to bring on a greenfield discovery. However, what we're seeing now is those brownfield expansions are now starting to tap very, very high capital intensities. If you look at BHP's $12 billion US investment decision in their brownfield expansions in Chile, that capital intensity is mid 20,000 per annualized ton of copper. So now we're starting to see these brownfield projects really starting to become very, very expensive. And that's a tipping point towards a push to bring on new greenfield developments. So with Hot Chili, we have a project that is scaled at around 100,000 tons of annual copper supply. We're one of only 5 independent copper developers in the world that is holding a project of that scale. And because of our low coastal advantage and our infrastructure advantage, developing down on the Chilean coastline, not at 4,000 meters elevation in the Andes, we have a capital of intensity of around 13,000, so about half that of BHP's committed brownfields expansion project. So we're starting to see this tipping point towards these cost-effective, meaningful scale projects. They're very, very rare. There's not many of them left, and so this is one of the things that Hot Chili has been really patiently developing and waiting for this moment in the copper cycle to arrive, which has now come. Yeah, in summary, yes, to both of those questions. Leverde is really something that's somewhat of a sneak attack by Hot Chili. It was 6 or 7 years to consolidate. We put the initial drilling in it. It looked very, very promising. And then we commenced phase 2 with all of the diamond drilling, which we're expanding. We have 3 drill rigs on the ground, and that has been shooting the lights out with results. We've been finding a lot of very wide, high-grade intersections around 0.7, 0.8% from copper equivalent from near surface. Those results have been coming into the market, and that has really shifted Hot Chili's attention to rapidly integrating this discovery into our Costa Fuego production hub. And that looks to change things dramatically for our project. We put a pre-feasibility out on Costa Fuego a year ago with vastly different long-term consensus prices on metals for copper and gold, which are in a much higher environment at the moment. But what Leverde is looking to do is to add a significant amount of higher grade feed to the front end of our operation. And so that tends to have a quite dramatic effect on reducing payback periods on our financial metrics, and dramatically increasing our post-tax NPVs and IRRs. So we're seeing a very, very big impact coming from Leverde. It's why the company is accelerating that drill out and looking to integrate that into a revised pre-feasibility at the end of the year and capture all of that upside. But in essence, Leverde has been a significant game changer for Hot Chili and is driving the re-rate of the company's market capitalization as we speak. Yeah, look, Leverde is in a very, very intensive drilling program at the moment. We've got some 22 drill holes outstanding. Unfortunately, the laboratories in South America aren't keeping up with the excessive amount of drilling that's going on. So we certainly have a huge amount of a news flow coming to the market that is going to be continuous throughout the year. What that is really going to be culminating in is a maiden resource on Leverde. We see that being very, very material to our 1 billion ton resource base. And that will be put out towards the end of the year. And then following that, we'll be looking to reposition our pre-feasibility off the back of that upgraded resource base, and look to take our mine life from 20 years out towards 25 to 30 years with the addition of Leverde. So it will be a large open pit, very similar to our 2 large deposits to the north, 30 kilometers away. And what's really impressive with Leverde is, this is a deposit that is going to just simply be bolted on, is not going to require much additional capital, has got a gold credit of some 2 to 3 times the gold credit of our deposits to the north. But it's most importantly, it's that access to higher grade material at the front end of our mine plan, which is a huge lever to the economics, which the company will look to demonstrate later this year. But certainly the type of drill results that the market has been seeing, the 500 meter, 700 meter intersections from surface, carrying some very, very good widths of strong grade. I think our last drill result included 61 meters at 1% copper equivalent. We're very much looking forward to delivering a lot more of that. But what's really, really exciting is the high grade starter pit that we are defining very rapidly over the top of that high grade core, which we've discovered from near surface. So a lot of attention is going into that area, and that material will look to probably impact year 1 and year 2 of Costa Fuego's mine plan. Yeah, look, I think that gap is closing. Hot chili is obviously outperforming most of its peers because the ceiling was a little higher for hot chili. Being an Australian, one of the few large-scale Australian copper developers within our peer group, we're somewhat of an enigma from Australia, but very much competing amongst our North American peers, which typically have always had a higher valuation multiple in that market. So that is something that we've set ourselves to correct. That's occurring at the moment, but as you point out, there are very few of us left that have advanced, meaningful scale copper developments that the majors do not own. And so, I think that you're going to see probably further M&A, particularly with the recent statements by the majors such as BHP and Rio Tinto and Glencore. This phase of mega mergers and mergers amongst existing books of copper production, is probably coming to an end. And most of those large companies are starting to now focus on what additional meaningful bolt-ons can be secured in the world. So hot chili is very much part of that mix, as we've seen over the last year. As you mentioned, we're very well aware that the M&A space is very hot, and that those PNAV multiples or EV per pound multiples are rising. I would probably say we're in an environment that is supporting 0.5 to 0.7 PNAV valuations on assets at the moment. So we've certainly got a long way to go with our re-rate. And I think that the alpha news flow coming out of La Verde is going to help. Obviously, the strong copper price environment is levering us further. And in addition to that, being able to demonstrate material, reshifts of value in hot chili's asset at Costa Fuego, I think is going to be very, very important this year to driving catalysts for the stock. Also, the hidden story in hot chili's Huasco water project, a project that we've been developing as a potential monetization opportunity to assist in funding this large-scale project. We're hoping to see some significant advance towards the securing of our second maritime license in the Huasco region, a dedicated desalination license, and hopefully seeing news on that front very shortly. That will certainly unlock a major part of our value proposition that is not in the market at the moment, and that's something that certainly a lot of strategics are very carefully watching also. Yeah, long term, look, water security for hot chili is paramount. We have a seawater license already to facilitate seawater processing at Costa Fuego, remembering, of course, that our deposits recover copper a little bit better with seawater, owing to the geology of our older deposits down on the coastline. But look, what we're looking to take advantage of is the ability to potentially supply water or desalinated water to an entire region that's hosting one of the largest clusters of undeveloped projects in the copper space in the world. So neighbors such as Vicuña with the Lundin and BHP team up at 4,300 meters elevation adjacent to us, and the guys even at ATEX with Valeriana in the future. All of these projects require desalinated water. So it's very, very large encumbrance to all of those projects not having that water supply within the Atacama, where you're no longer able to take water out of the continent. So this is a very, very strategic asset that we've been developing for many years. We have our hands on the first maritime license because we applied for it 13 years ago. It took us 10 years to secure. And that's when you could take water out of the ground. And we've had for many, many years a second application going on for a dedicated desalination license. So that looks to benefit not just large mining projects, but also the local communities of the Wasco region. And it's a project that we're very much developing in cooperation with regulators and with the government that are really promoting multi-user water networks to be developed in the Atacama to solve this water scarcity issue, and also bring benefit to the people that live in those regions, and also other agro-industrial and other commercial businesses that would look to benefit significantly from access to large-scale water supply.
Yeah, absolutely. So the demand math here is pretty straightforward. We're at 28 million tons of copper consumption this year. By 2040, S&P Global has demand at 42 million tons. BHP's longer dated framework gets us north of 50 million tons by 2050. That's a 50% increase in 15 years. So when you integrate that demand curve from 2025 to 2050, you arrive at roughly 975 million tons of cumulative copper consumption. So the world has mined approximately 700 million tons in all of total recorded history, period, going back 6,000 years. So we're going to need to essentially mine more copper in the next 25 years than humans have mined since the Bronze Age. Absolutely. So we have basically four converging vectors here, none of which have existed in this current form a decade ago. Well, first you have traditional industrial demand, obviously, construction, machinery, cooling appliances. And that base grows from 18 million tons to about 23 million tons by 2040, as we have, just as an example, 2 billion air conditioners get added globally by 2040 on Indian, Southeast Asian, African urbanization, and cooling is copper. The second, we have energy transition. So transmission and distribution alone doubles to 7.1 million tons a year by 2040. S&P pegs cumulative T&D investment at $7.5 trillion between 2025 and 2040. Solar adds another 600 gigawatts annually at 2.2 tons per megawatt. We've got EV usage, right? Uses 2.9 times, sometimes even higher, more copper than an ICE vehicle. And the world sold 22 million EVs in 2025. In 2010, it sold 10,000. So you can see how incrementally large that sector is getting. And then third, think AI and data centers. And this is what most consensus is kind of missing. S&P Global adds 2 million tons between 2025 and 2040 just for IT infrastructure associated with power generation. But this doesn't even include all of the copper wiring within those data centers that you need, and all the copper that you need for those cooling systems. So looking at just that, we have U.S. data centers consumed about 5% of U.S. electricity in 2025. By 2030, it's 14%. And so everybody's just looking at kind of that underground high voltage transmission cable, right, that runs, 19,000 kilograms of copper per kilometer. That's copper that goes in the ground, also doesn't come back up. You can't recycle it. But what everybody's missing, and what I've been talking about this whole time, is you can't be bullish on AI center capex, the data center build out themselves, without being bullish on copper. Again, because of the mass amount of copper that you need for those data centers, just the copper wiring inside, copper cooling, and people kind of aren't factoring that in. And then four, of course, you have defense. NATO has pledged 5% of GDP. Relevant copper demand from defense triples from 2040. You've got naval shipbuilding, electromagnetic launch systems, directed energy, hard communications, hypersonics, you name it. And this is, this is a big deal. Everybody knows nobody's cutting back on defense spending ever, particularly in North America, right? It just doesn't happen. The budget just keeps getting larger. And then there's also kind of a fifth vector that nobody's really pricing in yet because we're kind of not there yet, but humanoid robots. They are supposedly going to reach scale in the second half of the 2030s. That's 5 to 10 kilograms of copper per unit. And even the modest adoption is another 500,000 tons a year, even if, we just start incrementally. So those are that's a lot of demand right there. Well, yeah, basically it boils down to this. Supply has collapsed in the last 12 months, and the pipeline behind it is pretty empty. So there's your answer in a simple form. But if you look at Codelco, right, is kind of the centerpiece of all this. World's largest producer, Chilean state-owned, 20% of known copper reserves on the books, producing 1.3 million tons in 2025. That's below the 1997 figure of 1.23 million, right? Demand has more than doubled since 1997. The world's largest producer is kind of going backwards. They just got a new chairman who basically said, we're going to pivot away from production growth to profitability. So he is telling you their focus is no longer on increasing production. And so they're kind of, their 2030 targets kind of dead at the source there, right? Because that's not their focus anymore. Not to mention the fact of the declining ore grades there, because those mines are very old. You had Grasberg, Freeport's Indonesian asset declared force majeure in September after a mud rush event. Q1 2026 Indonesia sales were 82 million pounds, down from 290 million in Q1 of 2025. They cut 2026 guidance from 3.4 billion pounds to 3.1 billion. You've got Ivanhoe's DRC asset took a seismic event in May of 2025. 2026 guidance is down to 290 from 330,000 pre-incident. And Anglo American cut their 2026 Chile guidance by about 50,000 ton. Glencore is running 40% below its 2018 production peak. So if you combine, this is like more than 1.6 million tons of supply that consensus was modeling a year ago that will not happen in 2026, right? That's a huge thing. And now on the discovery side, major copper discoveries, defined as deposits above 500,000 tons, contained copper peaked again at 18 in 1997. The past 5 years have delivered 4. 3 of the past 4 years have delivered 0. So it's record low, and we all know CapEx, this is not also a copper problem too. We have to realize we have a lack of CapEx in the mining industry as a whole, for the better part of a decade. And so this is obviously going to be a big issue, not to mention how long it takes from discovery to actual production. That's over a decade sometimes. So so we need existing mines to stop getting worse, and we need a lot of new mines. Traditionally, you could have said higher prices would lead to demand destruction, and when we're talking, traditional construction, that's how Dr. Copper got its name, right? The global health of the economy. But this is not the case anymore, because the demand is policy driven right now. AA is not pausing. We are in a race against China, and these companies are not looking to get a deal on copper. They don't care what the price is, right? They don't care. Defense, legally mandated across NATO, legally mandated in the legally mandated in every country. That's not stopping anytime soon. China, India, not pausing on electrification. EV manufacture, they're going full bore with their electric vehicles. China, the largest EV producer in the world. So it's pretty clear to me that the only way this can resolve is with higher prices, because you have demand, you have price takers. They don't care what the price is for these industries. And I mean, one could argue you could use aluminum maybe for substitutes. I mean, silver is a great substitute, but that's even more expensive. And so, but, it's not ideal, right? It's not really a scalable substitute. So it's copper. You need copper, and that's it. So, my view is that, even right now, and, what was the highest settle? July 1st was like the highest settle we had at the 656 a pound. To me, in my view, that's like roughly 30% below where we actually should be at this point. And I don't think that that's going to resolve any time. I think the only resolution is higher price. It's just going to be higher prices.
The thing with silver is it's one of those metals that never trades like it fundamentally should. And that it's been doing that for the past 30 years. When I started in the mining business, we used to joke internally it was the devil's metal, because you'd think it should be doing one thing and it would do another. Now, having said that, these last few years we've been in structural deficit. We produce about 800 million ounces a year, and we're anywhere from 40 million to 60 million shortfall. And the reason for that is, if you look back, say 10 years ago, the industrial use of silver was well below 50%. It's now at 65. And I think what a lot of people don't realize is silver is the most conductive metal on the planet. So it has a lot of aerospace uses. We always talk about AI centers and call centers. They all use a lot of silver because of the conductivity. The electrification that we're undergoing now, silver plays a big role in that, obviously, with copper. So you're now at 65% industrial, and then you've got the financial aspect. Silver and gold kind of run in tandem. When gold moves, silver tends to go with it, which we've seen lately. Historically, there's a ratio for every 1 ounce of gold, how many ounces of silver? Well, it's usually around 50, and it's currently 58-to-1 ratio. So people that follow up that think maybe silver's got a further room to move, even when gold remains flat. So it's an interesting metal. I will tell you this, though, Thomas. From a company point of view, silver is a harder metal to get into production than gold, for no other reason than there's not a lot of pure silver plays. Most of them 70% of silver is a byproduct, either from copper or for lead and zinc. And there's very few open pit silver opportunities. So I think those of us that have good silver projects, we tend to hit above our weight class because there's so few of us. There's quite a few good gold companies, and the investor has, I'm just going to throw a few numbers out there, maybe 200 good gold companies to look at. There's probably 25 good silver companies. So when you do have something, there's a strong focus on you. But fundamentally, I don't see this changing with the industrial demand. In fact, I think it's going to keep increasing. The number one use of silver industrially is from solar panels, and solar panels are the number one renewable use for energy. So if that keeps increasing, the silver demand keeps going up, and we're not finding new deposits that often. I will say this, and I'm going to use a copper stat, but I think it's germane to all the metals. Since 1990, we've discovered 220 copper deposits, not mines, deposits. And in the last 10 years, 200 since 1990, In the last 10 years, we've only discovered 10. So there hasn't been, on the supply side, a lot of new minerals coming on stream, say in the last 10 years, but demand is increasing. And that's problematic. It's good for the mining companies because it means higher metal pricing. And I think for the industry, this is the mining market that we've waited our careers for, when we've got supply issues but increased demand. So here we are. Silver is viewed as a key part of electrification. If you look at the EV cars, and I'm speaking in particular to the Chinese vehicles, which dominate the EV industry, the electronics in those cars is staggering. And if you've seen any of the studies, when young people buy cars, I'll define young as under 35, they tend to look for technology. And silver plays a key role in that. So obviously on the EV side, but in any other application that you need a lot of conductivity, as I mentioned before, silver is the most conductive metal on the planet. So in all the new aircraft, the military uses a lot of silver. They don't say how much, but if you look at what's going on in the Middle East with the missiles and the defense systems, those all use a lot of silver. And I think it's obvious to say it's non-recyclable. So that's just the tip of the proverbial iceberg. So the numbers that I use for call centers and AI, right now, I believe they're using 3% of global energy. In the next 10 years, that's slated to go up to as much as 10%. And that just shows you how much that's being built out. They will need a lot of silver to accomplish that. And from a supply side, we're producing the same amount of silver that we have for probably the last 10 years annually, but the demand is increasing, which has put us into deficits. And the thing with silver too is there's no substitutes. It's the most conductive metal, and actually after petroleum, it's the second highest use of any product, of any commodity on earth, is actually silver, because it has multiple uses other than conductivity. The solar panels is a huge one, and that's about 28% of all industrial use of silver comes from solar panels. But if you look at the windmills and the renewables, they use a lot of silver. It's just one of those metals. I think people are finally starting to realize, hey, this is more than just gold's poor cousin. But having said that, we do have a saying in a bull market, which I believe we're in, when gold runs, silver gallops, because there's a lot more leverage. And I think you're starting to see that. I always get asked, what do you think the silver price is going to be? I kind of mimic what our largest shareholder of Aftermath Silver says, and that's Eric Sprott. And we're one of Eric's larger holdings. And, Eric predicted $80 silver by the end of 25. And I remember thinking, wow, that's optimistic. That would be great. And it happened. I used to, when we put the company together, silver was trading in the 20s. I was thinking if silver could hit 30, wow, that's fantastic. Now it's, say, 75. But Eric's of the belief that in several years you could see silver over $200, and he gives a myriad of reasons for it. Largely, he's a big believer in precious metals and gold, and thinks gold has a lot more room to go. Silver will go with it, and then you've got the industrial applications. So you've got the duality of the metal, which is, from a company point of view, fantastic. I think now, like gold, in any market, bull, bear, neutral, people will be buying good silver and gold assets. Manganese is an interesting mineral and metal. Just to give you a bit of background, there is a lot of manganese globally, a lot. But I think it's actually 90% of it is used in the steel industry.
Okay.
It's a different type of deposit. It has, we call it silica hosted. The manganese that we have is an oxide manganese, and it's at our flagship Berenguela project in southern Peru. It's the type of manganese that can be used potentially in EV car batteries. And if you look at all the chemistries for the car batteries going forward, you'll see the letter M, and M for manganese. So what manganese does, let's say there's two batteries. There's the LFP, the lithium iron phosphate, which tend to be favored by the Chinese manufacturers and battery manufacturers. That by adding manganese, they call it doping the battery. It gives them about 5% more efficiency, 5% more cycles. So it's become a key metal to add to the LFPs. The nickel, cobalt, manganese batteries, same thing. Manganese is more efficient than cobalt. It replaces it somewhat in the matrix. But it's also a lot cheaper than cobalt. Manganese in the United States, call it 2,500 a ton. Cobalt is 10,000. And 70% of cobalt comes out of the Congo, which a lot of people that finance big mining projects do not like because of the human rights violations that the Congo has been and is currently known for. As far as aftermath silver goes, there's a couple things to look for. One, we bypassed preliminary economic assessment last year, and we've gone straight to pre-feasibility study. And we have the technical team that's capable of putting this project into production. And I think that's a key tenet going forwards. Do the companies, are they explorationists, developers, or do they have the skill set with engineers and processing engineers to take it to the next level? We felt comfortable that we've got the team that's capable of doing this. They've done it before, so we're going straight to PFS. And that'll provide a lot of the economic parameters that we hope gets us a re-rating, and that's going to be out Q1 of next year, hopefully before the big Prospect Developers Mining Show in Toronto at the end of February. So look for that. That's going to be key. It'll have our economic numbers, our internal rate of return, net present value, the key things that investors should look for. But also, Berenguela, that's our flagship. It's an interesting project. It's called the CRD, Carbonate Replacement Deposit. Something caused that to be formed, and we're looking for the source of that. And as we've drilled further out east, we're hitting, our last drill hole we hit out east was 157 meters, 1.12% copper, 290 grams of silver with 7% manganese. That was one of the better holes hit in the industry, in my opinion, in the last 2 years. We're following up on that. I think we're getting closer to that heat source, which could be a porphyry. Yeah. But next month, look, we're going to start drilling in the other direction. We've got copper mineralization at surface up to 2%, and we're hitting on average over 0.5% in a lot of our soil sampling, and it's what we call skarn mineralization. Okay. It's a separate style than the carbonate replacement. It's 4 kilometers away, but that is definitely a key drill target. So we'll be drilling the skarn, and then we'll be drilling those eastern targets. So for our shareholders and investors, not only do they get the economic numbers Q1, they also get a lot of drill results coming in. And we've had good success drilling over the last 2 years. We've drilled ourselves over 108 drill holes. We've hit on 95% of them. 70% have been infill, 30% have been step outs. So, we've got a strong technical team, and fingers crossed that we hit on these targets. I say this, I would describe Berenguela as a tier 1 asset. And I describe tier 1 like this. It makes money, or it would make money, in my opinion, and the PFS will demonstrate this. In a good market, it makes, it'll be very robust. In a medium market, it will do well. And then in a bad market, it's still economic. That's a tier 1 asset. Tier 2 asset, only makes money in a good market. In a medium market, you've got to be a little careful, and in a slow market, get shuttered. So tier 3 assets, they're tough. So I think I would categorize it as a tier 1 asset. It's got copper. It's got 120 million ounces measured and indicated, another 20 million in inferred, 700,000 pounds of copper, another 300,000 in inferred, and it's got 3 million tons of manganese. So it's got they're all critical metals, and it's a big deposit, and the market likes it. Our market cap's around 280. I think we have a long way to go.